Let's take a look back at a screwy investment environment I call 2011. So this time last year when I stood up here, I said, I think it's time that maybe optimism could strike back. And that indeed was the case up until about April 29th. And then we had a few natural disasters and some geopolitical events. And by the end of the year, what we had instead was a bubble in pessimism. And so let's go and look at our individual predictions to see how well we did. So first, we thought that equities would set the upside tone early, which they did. We thought that earnings would rise, which they did. And we thought that optimism would stoke multiples higher. I'll give myself partial credit on that. The market did go up, earnings went up fine, multiples came down. In terms of size, we expected large companies to outperform small companies, and they did. We expected the growth style of investing to outperform the value style of investing, which it did. In terms of domicile, we actually expected the old world developed economies to fare better than the new world emerging economies, and that was indeed the case. In terms of U.S. interest rates, well, we thought that the curve would flatten. It did flatten, but not because rates rose, but because they fell, because the Fed launched a whole bunch of quantitative programs. In terms of the U.S. dollar, the primary pairing that causes the most drama on the planet is the dollar and the yuan. We expected that the Chinese would allow the yuan to appreciate further, which they have. That would weaken the dollar. In terms of bonds, we thought, well, if we're going to be in an environment of rising optimism, then likely we'll see rising rates, which makes municipal bonds and government bonds not effective. And so perhaps we should avoid rate risk, which would mean there were fewer return opportunities. We were wrong there. Treasuries had another monster year. In terms of the primary threats, this is kind of interesting. At the time, I really thought the primary threat was emerging market inflation, and the fact that the emerging market inflation would cause them to push commodity prices higher, which would lead to corporate profit margin compression. Obviously, that was not the primary threat. The primary threat last year was Europe's political fracas. Interesting side note, because of what went on in Europe, we actually did deflate a lot of the speculative activity in the commodities markets, and inflation in the emerging markets actually cooled. So we got some benefit for what happened in Europe last year. Okay, so we got most of those predictions right? And when it came to the stock market, we got almost all of them right. But it was still a crummy year. Why? Well, to answer that question effectively, we need to go back and talk about what actually determines market value. First, 25%, this is my judgment, 25% is macro. 25% is economic fundamentals. So how did the economy on the world do last year? The world economy grew about 3.5% last year, which is above its long-term average. So the economic fundamentals for last year were pretty darn good, certainly above average. 25% of the equation is also company-specific, microeconomics, if you will, corporate fundamentals. So how did corporations do last year in an environment of above-average GDP growth? They did great. They had record profits last year. So in 2007, pre the big recession, we got to a high in the S&P of a quarterly earnings rate of about 24 bucks. And most recently, we were at 25 and change. And so we had record profits. In fact, if you look at corporate profits in the U.S. as a percentage of GDP, a record high as well. Corporate profits right now constitute 10% of U.S. GDP against a 50-year average of 6%. So the macro level was good. The micro level was good. Unfortunately, that's only 50% of the equation. The other 50% of the equation, feelings, right? And so even though we had a strong fundamental environment, we had a very weak sentiment environment. There were plenty of things to be scared of last year, and let's kind of review them. So early in the year, we had the Arab Spring. And if you recall, there were some revolutions that are still sort of simmering over there. That took gasoline prices over 4 bucks, made everybody nervous. And then, of course, Stacy and I go on vacation with the kids, and there's a tsunami in Japan. So while they're at the pool, I'm watching CNBC. That, could have led to a nuclear reactor meltdown, and that could have blown over into, I guess, the west half of the country, and could have been Chernobyl and spades. And so that made us nervous. And then going forward, we got to a point where the Greeks finally said, yet again, oh, we're lying. Things are really not going well here. And so we got nervous, once again, about what was happening in Europe. And then we had the debt debate. Remember that? Wasn't that fun? So that freaked us all out. We got downgraded for the first time, which was quite embarrassing. And at the same time, we saw some weakness in the economic statistics, which, by the way, were caused by the tsunami, more or less. And then we got European proclamations to the point where every night, every 2 hours, I was getting up, getting on my iPad, which is a good and a bad thing, and reviewing proclamations from parliaments all over Europe. Basically, they were all inadequate. The market gyrated around. Finally, a couple of people lost their jobs. We threw in some technocrats. The Fed pumped some money in. By the end of the year, the S&P had traveled 3,100 points and gone absolutely nowhere. Right? And so we started the year at 1257.06, I think, and we ended the year at 1257.6. Pretty phenomenal. But there were a couple of things that happened specifically as we got into the silly season in the second half of the year. First, volatility went through the roof. Probably hard for you to see, but what this chart shows you is that last year, 40% of the trading days for the S&P 500 saw moves of 1% or greater. That's twice the historical average. This made it very treacherous for trading. The second thing that happened was we saw correlations go to a level we've never seen before. And so stocks were really trading as an asset class rather than trading as individual companies. This created a very binary environment. What I mean by that is you had the risk on trade or you had the risk off trade. You had, and every asset class got grouped into one of those two headings. You're either in or you're out. And in a market that becomes that Pavlovian, if you will, fundamental analysis was meaningless.